Good one. I'm glad you know which ones to hide. I'm going to give this man a quick intro. So most of you saw my video that I posted on the social media channels. John and I have known each other, I think, since 2011. John has been also on the national circuit. He has been a part of a bunch of masterminds along with me as well. He has completely gone from running and a fantastic tax preparer's office that we still use today to being a tax strategist, a litigator with the IRS. This man, with 3 sessions that I had with him, and you're right, you do have to raise your rates, but you don't meet with anybody privately anymore. So that's a good for you, John. In 3 different sessions, when I made my super secret spreadsheet, he didn't know I was doing this. I was taking all these notes and they would go back in and say, I'm going to make this spreadsheet, which incorporates all of these notes. That spreadsheet has literally saved me over $1 million in tax liability over the past 10 years. Now, there's a whole bunch of ways that happens. I'm going to let him tell you. He can talk about common stuff tonight. If you guys, I'm assuming this is Q&A format, right, John? So however you'd like this to go, he's very involved. He will not bore you. And if there's a topic that you guys all want to address, I think you can just type it right in the chat and we will be monitoring. Janine and I, thanks, Janine, we'll be monitoring the chat and we'll just kind of come in with questions. But that's it. I mean, I screwed up that whole intro, John, because I had it all typed up and tonight just completely sucked and went through the roof. So we appreciate you so much for coming and hanging out with us, and it's recording for all the people on the feedback on the
Okay, so glad to be here, and trust me, the snafus are all around. So here's where I'm at, because in Puerto Rico, you're always prepared for power outages. You're always prepared for the water not to function or the humans not to function. And you're always prepared for what in Puerto Rican Spanish is known as a tapón, which is a traffic jam. So I went to do my martial arts. I do a Philippine martial arts. I went to get a private class, had a wee little drink and cigar with my instructor. And there's a cluster on the way back home, which I actually anticipated just in case. I didn't plan on it. I wanted to be in my studio. I'm actually in my instructor's living room, which was kind enough to let me use. I got my laptop, I got my hotspot, because right now getting back to my place from here is a cluster. So it just sort of fits. But we improvise, we adapt. So there will be a little bit of background noise because they're having a regular class downstairs with Philippine martial arts. We do mostly knives and sticks and a little bit of sword and some empty hand. And so they're going to be stabbing and hitting each other. There may be some background noise. That's just part of the fun. It's part of the show. Also to flow, because this is a very flowy art. It's not like Taekwondo or karate, which I did Taekwondo and Muay Thai, which is a little more hard energy. This is a flowier thing. And so my instructor in his wisdom requires that we drink, and that will show.
That is a
so here's the drill. I take very few clients anymore. Almost everything I do is information product. I take just enough clients to have real live people still so that the info product is not obsolete. I'll up the rates. I'm presently at $700 an hour for the few people who can get me. You guys are off the clock. And the idea is to flow. Let's talk about what you want to talk about. I'll tell you what I'm into. I mean, at least as far as taxes are concerned, the rest of it we don't do on a recorded call. But at least as far as taxes are concerned, I do an awful lot with self-directed IRAs, self-directed 401ks. A lot of you dismiss them because you're like, oh no, I lose the tax benefits of my rentals. I think that's an incorrect approach. We can discuss that, but I do an awful lot in those areas, including ROBs, rollover business startups, which are one of the exceptions to the prohibited transaction rules. For those of you familiar with self-directed IRAs and 401ks, normally you're not allowed to work for your IRA or 401k. That's a prohibited transaction, providing services. There is an exception to the rule. In fact, when I'm in the United States, so why am I in Puerto Rico? Among other reasons, tax break. My tax rate is about somewhere between 4 to 7% total. I don't pay federal tax. So it's one reason to be here. There are a bunch of others we can get into as I drink more. My backup plan and what I would have done had I stayed in the States was the rollover business startup. Actually, when I'm present in the US, when I bill from there, which is very rare, or when I speak on stage there, Puerto Rico has no jurisdiction, right? That's US tax. So I run my speaking business in the US when it's physically in person through a rollover business startup, which is a C corporation owned by a Roth 401k. I'm allowed to work for the C corporation in spite of the fact that it's owned by a Roth 401k. I'm allowed to pay myself a W-2 from the C corporation in spite of the fact that it's owned by a Roth 401k. So what happens? I invested a fairly small amount in the C corp. The 401k, my Roth 401k, bought the C corporation for 50 grand. So very small capital outlay. This would work, for example, for flippers or wholesalers, just to give you some foreshadowing and spoilers. When I speak in the States, the C Corp charges, it pays me a salary, in my case, fairly small. I don't want a large salary. It pays its expenses, which are pretty small because a speaking business doesn't require all that much in the way of expenses. Whatever's left gets taxed at 21% corporate rate, which would be way below what my personal rate in the States would be. And then I distribute the remainder tax-free to a Roth 401k. And the Roth 401k, because I'm jamming my services into it, does this. And that's my fallback plan. If Puerto Rico ever sticks me in terms of tax law, then I'll probably be in Florida and running as much of the business as possible out of the ROBS, rollover business startup. So that's just an intro to one of the things I like to do. But I do a lot with real estate investors. Those are my primary clients, real estate. I do a lot with high net worth individuals and a lot with, you pretty much name it. Like recently we got a spate of dentists. And so we help with their practices and their practice structure, et cetera. So a lot of it translates, but I'm open to, I mean, we can talk depreciation, cost seg, cap gains, entity structure, entity maintenance, because I'm a lawyer and an accountant. So I get the tax side, the number side, but I also get the qualitative asset protection side. My instructor was kind enough to hand me a stick to remind me what it is I should be doing right now, which is hitting people, and I'm not, which is upsetting to everybody. So I'll just have the stick here. Usually it's a verbal stick, but we can go physical if ever needed. So with that, I'd say we free flow. Let's get into some Q&A, some planning, some discussion. I mean, tell me what you guys do, what you want to know. You've got me for the next, I don't know, Nick, what, hour, 2 hours? What are we doing?
However you want to go, I do have a couple that
last.
I have a couple that came in before the meeting even started. So one of them is, I think we can cover maybe some basics and then we'll go more into the advanced stuff. But one of them is, we always get this question, John. It's how can I structure I have a rehab company and I have a rental company. How can I best structure this? This person has the LLCs, they have the trusts, they have the trust that points to the LLCs. They would like to know, is there a good way to structure it? And what about that thing I heard called a management entity?
Okay, let's talk about, so the classic structure is classic for a reason. Now I do modify it. The first rule is if someone from Nevada or Utah gives you asset protection or tax advice, don't do that. Run screaming. It's just, I've been in practice 27 years. I have spent a lot of that time fixing screw ups set up at excessive cost by Nevada or Utah people who grossly overstructure and grossly overcharge to overstructure. Here's one example. I should have one LLC for every rental property. Well, unless your rental properties are very large, that doesn't make any sense. Typically, I set up, so what's the classic structure? We have a holding company. So we'll have an LLC that owns the other LLCs, kind of like Lord of the Rings, one ring to rule them all. So we'll usually set that up in Wyoming. Now, most of the time when you set up an out-of-state LLC on the theory that, for example, Wyoming law is better than Massachusetts law, which I assure you, without knowing much about Massachusetts law, I assure you that's the case, because Wyoming has not communists and Massachusetts has yes communists. And so their law is all screwed up, not very business friendly. And so people set up an LLC somewhere like Wyoming or Nevada or Delaware in the hope that that's the law that will apply. Well, most of the time, that's not the law that applies. If you have an LLC that owns a rental property in Massachusetts, most of the time, Massachusetts law is what's going to apply. It's just the way it is. Anyone who's told you differently is either stupid and hasn't done their homework, or did their homework and is lying. Either way, it's kind of like when we dealt with the Clintons. Like they were always like, well, it's incompetence. Well, I don't really care if it's incompetence or dishonesty. Either way, it's a problem. So when do we use out-of-state entities? Typically when the out-of-state entity owns solely personal property, solely personal as opposed to real property. Why? Because when it owns personal property, we at least have an argument that the property is owned, quote unquote, out of state, and that therefore out of state jurisdiction is what applies. Let me give you two examples. If I own stocks, I might put them in what's called street name, owned by a broker. So it's really kind of an informal trust arrangement. The broker owns it on paper, but I own it in reality. I'm the beneficiary. So it's an informal, unwritten trust. And because brokers are regulated, they have a very high fiduciary duty to me, the client. And so I'm not really worried about it being in their name. I know that functionally I own it. So street name. If I have stock shares with a broker in Wyoming, owned by the broker in Wyoming, I have an argument that those shares of stock, which are personal property, exist and live and reside in Wyoming. And so now I have an argument that Wyoming law is what applies. Well, with real estate, you don't really have that argument, right? The real estate is where the real estate is at. Massachusetts can get its claws into the real estate. So in terms of holding rental property or long-term holding assets, which I would include, by the way, most Airbnb type properties as well, short-term rentals, I'm going to have a local LLC own, and I'm going to have the owner of the local LLC, in this case, a Massachusetts LLC or whichever state you're in, be owned by a Wyoming LLC. Why? Because ownership of a Massachusetts LLC, well, a Massachusetts LLC's shares, like stock, are considered personal property. So I have an argument that if a Wyoming company owns shares in a Massachusetts LLC, the property lives in Wyoming. It's an argument. I might lose. But does it put up a roadblock to a creditor? Do they have to go to Wyoming, Massachusetts, or both to litigate what's the jurisdiction that's relevant? Yeah, they do. So we're at least putting up a roadblock. Maybe we win, maybe we don't. And I'll give you a hint. In literally 99% of cases, we never find out. Why? Because we settle. What's part of what drives the settlement? Would you like to come to Wyoming to litigate? No? Then I need a settlement that satisfies me. So the classic structure, a holding company that owns the little LLCs own the real estate. Now, how much real estate? As much as you're willing to maintain. Let me explain what that means. And this is where the Nevada, Utah people really fall down. Well, I think, says the Utah or Nevada idiot, each LLC should own one property so that if I get sued, all that can happen is that one property is vulnerable. If that LLC is pierced, just that one property is open to seizure, the holding company protects the other LLCs. Wrong answer. Here's the problem. Size does matter. So sorry, disappoints a lot of you, but don't confuse the context. Size matters, at least when we're talking about LLCs and a court's willingness to pierce it, right? If you've got an LLC that owns real property, and let's say you do the old equity stripping, so the LLC doesn't have much really value, do you really think a Massachusetts court is going to let that fly? And here's the answer, no. In fact, there was a Massachusetts case where somebody put one taxi cab in each corporation on the same theory. If there's an accident, only that taxi cab is vulnerable. Massachusetts went through that like a hot knife through butter. And with good reason, by the way. I don't really want to live in a world where somebody can have one taxi cab per company, do whatever the hell they want with each cab, and only lose one cab and therefore really do whatever the hell they want. That's not a world I want to live in. And I'm a Republican, and even I'm against that. So there has to be enough in the entity, and there's no defined number. The courts don't lay out a specific number, but there has to be enough that they consider it to have economic substance, that it's quote unquote fair. That's why we call them limited liability companies and not no liability companies. If you try to use some of these techniques to not leave anything on the table for a potential victim or plaintiff, you try to convert a limited liability company into a no liability company, especially in a place like Massachusetts, that's going to blow up in your face. The object is to limit the damage, not eliminate the damage. So what's enough? I would say at a minimum, 300 grand net equity per entity before I start thinking about a second entity. 300 grand per entity net equity before I start thinking about another entity. Now, in theory, let's say the properties you own are mobile home parks and they're large, a net $1 million net equity per mobile home park. Can you then have one LLC per mobile home park? Yes, if you're willing to properly maintain them. And that's where a lot of you fall down. This is where a lot of the lawyers don't tell you need to know. There's a lot more to maintaining any entity, including an LLC, then most of the advisors will tell you because they don't do their homework. Let me tell you what most Nevada, Utah people say. Well, the LLC statute in most states does not require annual meetings, does not require minutes or resolutions or any of those things. Therefore, it's not required. Wrong. If you look at the case law, when they're looking to pierce an LLC, and I've read the case law across the nation, and it's fairly consistent. There are some differences between states, but there's a lot of consistency. Judges don't like inventing things brand new. So when they're deciding whether or not they're going to respect the existence and asset protection of an LLC, what do? They borrow from corporate law. Well, what are corporations required to do? Separate bank account. If you have an LLC with no bank account, you got squat. An LLC without a bank account, pardon my French, is a bullshit LLC that is very unlikely to protect you. Because an LLC is a financial person. It's made out of paper. The object of that financial person is to act like Biden with a 9-year-old. No, wait, really, we can record this part. I don't mean anything abusive, nasty. I mean, Biden would hold a 9-year-old in front of him, assuming he had the muscular strength, which he doesn't, because that would require like lucidity, which he lacks. But he would hold the 9-year-old in front of him to protect himself from an assassin's bullet. And the 9-year-old eats the bullet. Well, that's how you use LLCs. The LLC, you hold it in front of you and you let it eat the legal bullet. You walk away, the LLC is gone. That's the idea, limited liability. The LLC eats it, you don't. The problem with that approach is courts will look at the fairness, the equity. They look at, is the financial person a separate financial person? How can you be a financial person without a bank account? Well, my lawyer said, we can run everything through a management company and the LLC itself doesn't need to have a bank account. You got yourself a bogus LLC. That's not going to survive. That's very unlikely to survive attack. All LLCs, all corporations have bank accounts. And they keep the personal expenses, your personal expenses, separate from those of the entity. The fastest way to destroy an entity is to use the entity bank account to buy anything that's personal. You forgot your credit cards, but you have the company credit card. You go to Walmart, you want to buy some nice Angel's Envy rye, which I recommend, and you forgot your personal card. You got the company card. So you're like, I'll buy the Angel's Envy on the company card and I will pay back the company. I will reimburse it. No, absolutely not. Go home, go get your credit card, go get your cash. You do not spend company money on personal stuff. Fastest way to blow up a company. Now, the reverse isn't quite as bad. In other words, if you spend money personally on a business expense, can the business reimburse you? It's not the best practice. I don't like it, but it can reimburse you. If you have what's called a qualified reimbursement plan, which is what the IRS wants to see, it's a 1 or 2 page doc that says, if you bring in receipts and you bring in proof that this was a business expense, the business will reimburse you. Now, I don't like it. I think it's sloppy. Why do I think it's sloppy? I want you used to paying for things from the business. I want you used to putting money into the business and the business pays its own way. But can I accept the business reimbursing you for a business expense? Yeah. Can I accept the opposite? You reimbursing the business for a personal expense? Absolutely not. I want annual meetings. I want unique minutes for the meetings, not some idiot template bought from some idiot online that's identical for each one except for the date and the name of the company. What's an example of meeting minutes? They're not that hard to make. You guys always whine. Oh, the meeting minutes take so much time. You do this already. You guys talk to each other about your businesses. What's a meeting? What's an annual meeting? I get together with some cronies. We get some dead cow and fermented grain products, and we have those tax deductible. And we discuss business big picture items. Maybe we record it with everybody's consent, rather much like this call. And then we have somebody in the Philippines or an algorithm or both put it into writing, we edit it, we add the annual things like, look, we had a vote, and shockingly, I, as 100% owner of the company, voted for me as the manager. Who knew? And so that's where the boilerplate, the stuff you do every year, comes in. So there's a list of things you need to do to maintain these entities, even if the entity is of a size that it's worth having. So think twice before you have 5, 10, 20, 40, 50 LLCs. Because if you're not maintaining them right, and you probably aren't, I've been around entrepreneurs for a while, you guys are usually concerned with making deals and less concerned with paperwork, admin, and backroom stuff. Really think about, am I going to maintain this structure? So the classic holding structure versus transactional. Holding is I have an asset, whether it's a rental property or a long-term rental or a mortgage or note I bought at a discount or crypto or gold or whatever. Damon, get off the porn line. I can see you. Good Lord. So this is the classic structure for holding assets for appreciation or that produce income, rental properties, notes, et cetera. Now there's a different structure for operating companies, a wholesaling business, a flipping business, a law practice, whatever. We'll get into that in a minute. So I just threw a lot at you. Let's go through some of the questions in the chat box. Or Nick, how do you operate in terms of, like, do people raise their hand? Can they actually talk? Do we do that?
We could. I mean, people are popping stuff into the chat box. If people want to unmute themselves, they can. I'm just sorting through. A couple people had. I won't go that basic. So Jack, we're like, this is an intermediate group, so we won't talk about what is a self-directed IRA. So Jack, we can talk about that offline. But self-directed IRAs versus trusts, and then we have a couple other people. We're getting into the other details, but I like that you're still in basics. Let's move from entity structuring into, you started mentioning really sexy tax deductions. What about a business vehicle, John? I saw you post that on your Instagram the other day.
Okay, business vehicle. Let's define the term so that we're all saying the same thing. Here, first, because it is Puerto Rico and I have no AC, so guess what?
The one benefit of being up north, the one.
Dude, the benefit of being down here, the bad news is in the summer, it's humid and it's sticky. The good news is people you're attracted to don't wear much, and what they do wear sticks. So, I'm going to go with the glasses half full here.
I'm pouring through faces in the chat, just wondering if anyone's offended yet. It looks like we only have a few offended people, so that's good. We're doing okay.
Wait, this is Massachusetts. That's right. I forgot to give the caveat. Just in case you missed it, I don't speak woke. I don't do politically correct, and I don't care about your feelings. If you're offended or easily offended, if you're over the age of 12 and you've used the term "I'm offended" and expected an adult to care, this is a great time for you to go do something else. Right? Because you probably voted to increase taxes, and my suggestion is you pay them instead of coming to me looking to get out of what you created. So screw you if you're in that category. I didn't think many of them would make it past you, but if you had a few infiltrators, Nick, I think they'll be gone. So in terms of a business, now I'm talking about when I say business in this context, what type of entity do we use? Let's define the term. You make your money from mostly providing either services or selling inventory, meaning selling the same thing over and over, even if it's real estate. So an active business. What are our options? I would say 4 primary options. If the business is pretty small, do nothing. If you're just getting started, don't overdo your entities. Don't go to one of those idiots that charges you 5 to 10 to 15 to 20 grand to set up this elaborate structure that you may never need. Right, because to have asset protection, we have a requisite, and it's known as assets. And oftentimes when you're getting started, you lack that. And what you should be putting your money in when you're just getting started is education and marketing. You need to go out and get assets and get income. You don't go paying the lawyer, you pay them some to keep it simple and give you some advice that's good, but don't overdo it. Over time, as you have more assets and make more money, the structure becomes more complicated, the complexity pays for itself, and you can afford the complexity. So there's a nice fit there. Now, with businesses, we start with do nothing. Do the first few deals in a simple LLC. Nothing fancy, one LLC, single member. No, single member LLCs don't get the same respect as multi-member. They don't. I know the guru from Nevada told me add a 1% partner, and now we have a multi-member LLC. Well, like most Nevada, Utah guru schlock, it's schlock. What's the problem with that approach? The same judge that looks at a single member LLC and says, listen, I'm not going to respect it because what's the policy behind some of the asset protection? We don't want to hurt other people. So if I got partners, I got employees, part of the idea of a business entity is to protect those people. Well, if you don't have any of that, the courts are more prone to looking and saying, listen, those people the law was designed to protect aren't present. So it's not that we're not going to respect the LLC if it's single member, but we are going to give it less respect. It's going to be easier to pierce. We're going to have more of a hair trigger on deciding whether or not we're going to go through it. And so especially if you have a single member LLC, you have to be really careful and diligent about the maintenance. I'm going to add a 1% partner. The courts look right through that. Again, the courts look at the substance typically. They call bullshit. Oh, I got a 1% partner and it's my dog. Oh, congratulations. You're a multi-member LLC. You're entitled to all these benefits. Isn't that special? No, they want to see a substantive partner, 5 to 10%, that actually put money in the deal and that is getting money and is on the tax return and getting a K-1, for example. And that itself is a pain in the butt and creates its own risks. The cure is worse than the disease. I'm going to go get a 10% partner that I have to give real money to and who's an actual partner with votes, even if I can outvote him on most things. Yeah, he's 10%. What do you mean most things, John? Well, some states, that's less than 50%, certain veto rights, depends on state law. You got a real partner, you got a more complicated tax return, you got somebody who can whine or complain. Is it worth it in order to have extra asset protection just in case you're sued and just in case you lose? I don't think it is. I don't think that makes practical sense. So if you have a single member, you're kind of stuck with it. And you got to understand that they get less respect and you're going to have to be extra careful and diligent about maintenance. So what are some of the other options for a business that has a lot of inventory sales or provides services? Well, we're usually worried about self-employment tax, which is just another word for Social Security tax, right? It's just a variation on Social Security tax. Then our default option is an S corporation, or more typically an LLC taxed as an S corporation. This is for you flippers, you assigners, you realtors, me providing services. That's Social Security taxable. What does an S corp get you? The S corp pays you two ways: a salary and distributions. Let's say I make 100 grand. Maybe it pays 40 grand in salary and 60 grand in distributions. Well, all 100 grand is income taxable, but only the 40 grand of salary is self-employment or Social Security taxable. So you got some savings there potentially, depending on your numbers. And without going into your numbers, that's more of an individual thing where we get into looking at your return, your business, how much it generates. But that's the only reason to have an S corp. If you have an S corp for any reason other than reducing self-employment tax, you got an S corporation for the wrong reason. Sometimes we do C corporations. Typically, it's a bracket arbitrage game. In other words, you're making a lot of money. Your personal bracket is 37%, top federal rate, and the corporate rate for a C corp is only 21%. Well, that's a 16-point difference. And there are some other things that you can do to put your thumb on the scale for tax arbitrage. That's the big one, but there's more. What's the problem? Well, there's always strings attached. There's always a catch. And the catch is, to get the 21% rate, you got to keep the money in the C corp. Right? The minute you distribute the money from the C corp, you got the famous double tax, and you're back to roughly 37%. And so you got to keep the money in the C corp, growing in the C corp, without touching that money for the most part. There are limited ability to make loans from the C corp and so on. Again, there are a lot of rabbit holes we can go down. Are there some ways to extract money from a C corp without paying dividends? Yeah, it's not as great as the Nevada people would have you believe, because, well, Nevada people. But the C corps are usually for high income people. They want bracket arbitrage. 21% sounds a lot better than 37%. There is this sort of marketing out there that says C corporations have a lot of extra tax deductions compared to normal entities. And that's not really true, with maybe one big exception: healthcare, right? A C corporation, without getting into details, can help you qualify for a health reimbursement account, which pays your healthcare expenses tax-free. Now, that only works if you don't have employees. If you have employees, you're kind of forced to pay their healthcare expenses, which could get really expensive.
I learned that. Thanks for that, by the way. That was a rough call.
So yeah. So that's C corps. And then we got the ROBS structure, rollover business startup, I described, where I have a C corp. It's owned by a Roth 401k, and there's a procedure. You can't just go set it up. There's a strict procedure. Wait, Puerto Rico. Glorious. Nobody wanted to see that. We'll have to edit that out. You have a C corporation. It's owned by a Roth 401k. You're allowed to work for the C corp. You're allowed to make a salary, which means you can pay yourself enough salary to live on, even though the C corporation is owned by your Roth 401k. Let's just make up numbers. I make $1 million speaking. $100,000 in expenses. I don't know, traveling and maybe drinking, whatever. And so I have an $800,000 net income. Nick, can you hear me okay? Sometimes the internet here gets funny.
Yeah, you cut out for about 5 seconds, but you're back.
Okay, cool. It usually tells me when we do that. Again, Puerto Rico, a lot of great things about being here. Great internet service is not on the list. So you have a C corporation. It paid you $1,000 in salary or $100,000 in salary. Spent $100,000 on expenses, $800,000 net income. You pay 21% federal tax plus any relevant state tax, and whatever's left can be distributed to the Roth 401k tax-free. Because when a C corporation gives me or Nick money, we pay a 20% dividend tax. Well, how much tax does the IRA or 401k pay when it receives dividends from a C corporation? 0. So the Roth 401k is getting this huge amount of money per year, basically from my services. And it can invest tax-free in most things. In most things, there's always exceptions to the rule. We can get later on, if we have time, into UBIT, there's tax on 401ks and IRAs. But that is one of my favorite structures. What's the number one impediment to having a ROBS, rollover business startup structure? Employees. If you've got employees anywhere in your structure, it's not impossible to have one. We may be able to structure around the employees, but now it's going to take some work. Usually, the classic way to structure, if you've got employees, because what does the law say? If you have employees anywhere in your controlled group, a legal term, your controlled group, they have to be offered ownership in the C Corp, which is suboptimal. The classic way around that is that the C corporation that is owned by the solo K or the Roth 401k is owned 79% by the 401k and 21% by some other non-related person. So if you got a partner, there's someone you're willing to partner with, and they have to be a real partner. It cannot be a bogus arrangement just on wink, wink paper. It's got to be real. But if you have a 21% partner, your 401k, your Roth 401k owns 79% of the C Corp. Some unrelated person, honest to God, for real, owns 21%. They put in money, they get out money, they're real. That might break through the controlled group rule where you don't have to include employees in that structure. So we do this for dentists, for example, who want to set up a new office. They have a bunch of employees in their other offices that would normally have to be included in the ROBS structure, which is not optimal. But then they find a junior dentist that they want to reward, and they give them 21% of the C corporation from day one. Okay, that'll usually, and again, I got a caveat because there's always details, and we're on a call for an hour or two. I don't have time. You don't want to hear the details. You haven't had enough to drink. I have, you haven't. Usually the 21% will break the controlled group, and the ROBS will be free of all the other employees. That's my favorite structure. Guys, this is my plan B. If Puerto Rico screws with me and changes the law, which, look, you think American politicians are bad. Puerto Rico makes California look like libertarian paradise. As long as I continue to get the tax deal I'm getting, I'm good. If they manage to somehow screw that up, and they have a talent for doing that, my buttocks will be in Florida. And off I am running things through the ROBS plan, and I'm growing it as a plan B. So those are really the 4 options for a business, an active business that you're providing services, you're selling inventory, a basic LLC if it's small until it gets big, an S Corp to reduce self-employment tax, a C Corp for tax arbitrage. Could you have both? Could you run a flipping business through an S Corp? I'm going to run 8 deals through that. And a C Corp, I'm going to run 4 deals through that. Yeah. Yeah, there's nothing in the code that says you have to run your whole freaking business through one entity. You may be able to split the business up. Can I have 3 entities? I have a C Corp and a Robs and an S Corp that's doing my wholesaling or my flipping or whatever. Sure. Sure. So again, you got to keep your minds open on this. And a lot of the accountants out there, they don't even know the technique exists. And when they do hear of it, they're not precisely what one would call open-minded. So again, typical lawyer, long-winded, caveat-filled answer to what looked and sounded like a simple question, but really isn't. And that's the key, guys. I mean, I can give you generalities and I can teach you some of the possibilities, but it's ultimately analysis by a professional. And no, that's not me pushing my services. I have more clients than I know what to do with. Would I take clients? Yeah, as long as you can deal with the fact that I'm a pain in the ass. I'm a really good at what I do, pain in the ass, but I'm a pain in the ass. I only bill 3 hours a day. I spend most of the rest of my time on content and investing. And that means that I'm really good at planning. But for me, am I your tax guy? Good Lord, no. I would screw that up in a New York minute because I'm so busy. When you call and say, I have a closing tomorrow, I need advice immediately. That's not going to happen. I'm a good planner. I'm your tax guy. Now, can I train your tax guy to be a decent human being and perhaps even useful to you? Yeah, that's a different matter.
Brilliant. This is awesome. So as you guys are all seeing already, this content is very high level, and there's so many unique tips and tricks here that John and his team have arranged for everybody. Depends on where you are, right? If you're at the beginning of the scale, you have one option, one strategy. And if you're at the end of the scale and you have tons of income and you're looking to shelter, you have like 3 or 4 other strategies. We have a couple, the sticks out. We have a couple good ones to go back when it's not a 401k Roth. On says, well, how do you fund a Roth IRA more than what is allowed? That's a good basic question that I think you can help with.
Well, I don't ever fund them by more than what's allowed. I follow the rules. It's just my reading of the rules might be a little different than other people's reading. So what are some ways to get more money into any retirement account? Let's not restrict it to Roth IRA. I mean, it can borrow. And if it's a 401k, the borrowing rules for real estate are much more favorable than an IRA. Borrowing through a 401k for the 401k to acquire real estate is a lot more favorable than borrowing through an IRA or an HSA, a health savings account, or a CISA, Coverdale Educational Savings Account. You can have preferred dividend partners. I can have an IRA or 401k that, oh Jesus, you're letting Dave Tilney in?
Uh-oh, who is that? Who is that? Should I take
Dave Tilney is allowed in? That you have no standards. Oh, dude's a major dude. Tilney is a landlording guru who is the feces. He doesn't just know his feces, he is the feces when it comes to management of rental properties. Dude's really on, God, this is not recorded, is it?
Hi, John.
Lord. Hey, Dave, how you doing? I was just
Good,
talking
how are
about
you?
you. Good to see. I got to get over there to Naples. I know I've
Well,
been
now I'm in
promising.
Col-
I'm a
I'm in-
lawyer, and you know what my promises are worth.
Yeah, but I'm in Colorado Springs right now. You'll have to wait till the fall.
Actually, Colorado Springs, I was there not too long ago. You have good restaurants and a proper drinking scene, and you have good places that sell bourbon.
That's
You know,
all
I
that
think
matters,
they have
Dave,
that
see?
most places.
So, well, glad to have you on here. Appreciate any questions you got. For those of you not in the know, I don't recommend a lot of people. I don't like people in general. And David's not really a people, so he's he's just really exempt from the rules to begin with. But he puts on one hell of a landlording class. I have to give him a shout out there. He knows his stuff. He's not just knowledgeable, but ethical. Such a rare combination these days. And by the way, what do I get from David for having said that? David, do tell them what I get out of that.
Well, I mean, you might not get anything, but we have a 50% referral fee here on REI Unleashed. No, I'm just kidding.
Yeah, you get nothing.
I get
But I have
nothing.
invited you to come see us in Naples.
You know what? Just contact the Chilean. For those of you unaware, I'm married to a Chilean. Anyone married to a Latina knows how this works. You just tell her what you want, and then she'll tell me what I want, and then suddenly that's what I want.
Now you might ask her, we're going to Antarctica in January. And so we'll be in Chile for a little bit too. She might want to come.
Oh, and if you're going to run through Santiago or Viña, we can put you together with some of her family. I assure you the drinking will be good. I'm not sure about any of the rest.
I love this, Dave. Listen, I had to go through his assistant. I'm going to make you do the same thing. No, I'm just kidding.
I'll shut up and get off.
No, don't
Yeah.
get off. I appreciate you being here, my friend. Thank you so much for jumping in. That's awesome.
Yeah, no, you got questions, let me know. So we were just chatting about ROBs and how to put more money into IRAs and 401ks. So we started out with borrowing. There's the preferred dividend structure. Your 401k or IRA is a partner in a deal. This is key. It puts in at least 20% of the money. It puts in at least 20% of the money. It owns all the common shares in the deal. Someone else comes in, let's just say a civilian who's happy with an 8% preferred return. They put in 80% of the money. They get their 8% money, you pay them off. The IRA or the 401k gets whatever's left, a classic common preferred structure. But the IRA or 401k has to put in skin in the game. Because here's the one I hear. Well, my IRA is a partner in a deal and it didn't bring any money. Nick brought all the money. Really? And so why is your IRA a partner in the deal? What does it bring to the table? My IRA finds deals. Bullshit. Your IRA doesn't find squat. It's a piece of paper. Your IRA can't even find as much as Biden. And that's saying something. I mean, your IRA is just a piece of paper. It can't find or do anything. You're the one doing the work. Well, what happens when you do work? You find deals. You run the deals. That's personal services income. It goes on your 1040. For the IRA to be a legit partner in a common preferred relationship, it has to have some skin in the game. My rule of thumb is 20%. So if it's $100,000 in, IRAs bring in 20 grand. Can you then help the IRA find deals now that it has skin in the game and is actually doing what IRAs do, which is invest money? Yeah. Now, what's the advantage of this over debt? No UBIT, right? A lot of you who are familiar with UBIT, unrelated business income tax. IRAs and 401ks are tax-free except when they're not. Three things cause tax, also known as UBIT. IRA tax equals UBIT. UBIT equals IRA or 401k tax. When an IRA or 401k borrows money, it owes UBIT. Now, 401ks have a special exception to the rule. If a 401k borrows money, listen carefully to the words. When a 401k borrows money to acquire or improve real estate, it does not pay UBIT for having done so. Now, here's what a lot of people mistranslate that to mean. 401ks never pay UBIT of any sort ever. No, not what I said. 401ks follow the same UBIT rules as an IRA with one really important exception. Where an IRA is taxable for borrowing on anything, a 401k is taxable for borrowing on anything, except when it borrows to acquire or improve real estate. That's a big deal. The second thing that causes UBIT is renting out personal property, cars, rent-a-center furniture, meth labs. That all gives rise to UBIT in any retirement account, 401k, IRA, et cetera. That's the second thing. The third thing that causes UBIT in any retirement account, 401k or IRA, is when it runs a trade or business that is continuous. And that's a term of art. For example, how many homes do you have to flip until you have a continuous trade or business? That's a great question. So if you have a trade or business in one of these types of accounts, it pays UBIT. So we're always looking at those issues. What's the advantage of having a preferred structure? So remember the preferred structure. My IRA brings, let's say, 200 grand to a deal. Preferred investors bring 800 grand. They get an 8% return. They get their money. They get their money back. They get their 8% return. The IRA keeps everything else. It's leverage. Except what? There's no UBIT. Why? Because it's equity leverage, not debt leverage. UBIT only applies to debt leverage. Here, you got equity leverage. You got partners taking an 8% preferred return. You don't have a lender lending at 8%. Big difference between the two. That's one way to put more money into these accounts. Taking full advantage of the contribution limits. 401ks, and again, without going into the details, a lot of your accountants are telling you, well, you can only contribute 20 grand or 25 grand to your 401k. No, actually, the number is closer to 60 to 65 grand. If you're not contributing that much to a 401k annually, you're probably under contributing what you could have. You can also sometimes have more than one 401k. Do I have clients with 2 or 3 401ks contributing 65 grand to each one, plus to their IRAs? Yeah, and the key is that they have 3 separate controlled groups. And again, getting into controlled groups itself would be a 2 or 3 hour webinar just for accountants and make you want to kill yourselves and others. Just understand that there's a term, controlled groups. And if we manipulate the definition, I might be able to arrange for you to have 2 or 3 controlled groups. Each one is allowed to have its own 401k, and each 401k can take somewhere between 60 to 65 grand of contributions. So those are some thoughts on, and it's by far from exhaustive, just some thoughts on how do you jack up how much you're getting into these accounts.
That was brilliant. That was really good. On to there's, well, I maybe I'm not supposed to say this with John on, but there's the, you know, that Gina educated me on the backdoor SEP way of also filling up a Roth. Maybe should I not talk about that with you here on the call? Maybe not. All right, he's drinking. That
It
means
depends
no.
what you mean by backdoor. I mean, that's a rather broad term.
In Massachusetts, we only have one definition for that up here.
Yeah, I know what that means in Massachusetts, and that's exactly what I didn't want to talk about. Let's talk the tax term.
All right, tax term of backdoor. So on again, this is again, I'm going to defer to John on this, but what we did in the past is, right, you're over your income limit for your Roth, and therefore you're not able to without penalty. So you are able to still push money into a SEP IRA if you don't already have a solo 401k set up. And then at that point, you're converting that money into a Roth on by December 31st of that year. Does that make any
Yeah,
sense?
that's changed a little bit since we last spoke. So SEPs used to be the procrastinator's 401k. The 401k is a superior account to all retirement accounts. Again, without getting into all the reasons, here are a few. 401ks are not destroyed by something called prohibited transactions. If you commit what's called a prohibited transaction in an IRA, SEP, HSA, Coverdell, it destroys the account. Things like working for the company, things like lending money to disqualified persons. Again, a whole separate webinar on what's a prohibited transaction. Bottom line is, if you have a prohibited transaction outside of a 401k, the account in question ceases to exist, and there are very negative tax consequences. One of the nice things about 401ks is if they commit a prohibited transaction, not that we would do that on purpose, but the rules are complex. Let's say we accidentally do it. The penalty is much smaller. It's a percent of the transaction. I mentioned that when 401ks borrow on real estate, they don't pay UBIT for having borrowed. So there are advantages. I'm not naming them all because, again, we have X amount of time. So for the moment, trust a nice lawyer. The 401k is the best retirement account of all of them, 97% of the time. There are a few exceptions, there always are, but normally that's the best account. Now, you can have multiple accounts. The reason people used to have SEPs is because you entrepreneur sorts procrastinate. You don't fund your 401k by the end of the year. SEPs have large contribution limits, very similar to 401ks, and you're allowed to fund them beyond the year end. Well, some fairly recent legal changes to 401ks, the Secure Act, allowed a certain amount of 401k funding for, let's say, 2022 after December 31st of 2022. Now, I still wouldn't wait till after December 21st or 31st of 2022 to fund your 401k, but there is some ability to do that now. When people did not have that ability, we would set up a SEP so they could fund for 2022 after the year end of 2022. It allowed them to basically get away with procrastinating one time around. And then we would later convert it to a 401k. That's become less necessary given changes in 401k law. So, and then the backdoor Roth, I'm not going to spend time on it because so I like to focus on comparatively unique content. Things I come up with are not things you'll commonly hear. The backdoor Roth IRA is common schmomen. I mean, you can just Google it and it's out there. You don't need me to tell you that. That's easy peasy. So Google backdoor Roth IRA. For those of you who think you don't qualify for a Roth IRA because you make too much money, there is presently a way to still have the Roth IRA by putting money in a traditional and then converting it to a Roth. Just Google it. It's not worth my time to explain it. It's too basic.
Perfect. Awesome. A couple in here. We can come to some of these later. You know what? Someone just brought up short-term rentals. This is the hot spot, I think, for a lot of people right now too, right? So let's dust yourself off. I saw you had an amazing webinar on this already. If there's anything you're willing to share, so these just came in full force about 5 years ago. They've been here for 10 years, but 5 years ago they became the new hot button. 4 years ago they became the new hot button. Then COVID happened and they blew up, right? There's the specific question we have here is, but I think if you can cover the generic term, what happens with short-term rentals versus long-term rentals, and what's the pros and cons of classifying as either? And then a few other people have specific questions. If I own one investment property, is it possible to deduct a net loss from a short-term rental property against ordinary income to reduce Fed tax liability? Lots of
Yeah, the passive loss game, sure. So let's start on that. Here's the problem with, and I'm going to use the term Airbnb the way we use Coke to mean, cola, or the way we use Kleenex to mean tissue.
Yeah.
Short-term rentals, Airbnb, they're synonymous terms. The problem with Airbnbs is that they're divided into two categories. It's either a rental or it's a hotel, and the treatment's very different. And here's the problem: the definition is not consistent. That's the key that complicates everything. The definition and what is a rental changes depending on which part of the code we're looking at, the tax code. And that's where a lot of accountants miss it. So for example, does my Airbnb for Social Security tax, self-employment tax purposes, is it a hotel? Okay, well, that question is answered by, do you provide substantial services? Put it in quotes, write it down, substantial services. If in connection with your rental property, you provide substantial services for Social Security tax purposes, it's a hotel. If you don't provide substantial services, it's a rental. Now, why does that matter? If it's a hotel, it goes on Schedule C, where you pay self-employment tax. If it's a rental, it goes on Schedule E, where it's treated like a rental. And by the way, a lot of you guys and a lot of your accountants will be like, no. Schedule C is for a trade or business, and that's all that goes there. And a property that's rented never goes there. Read the effing rules, Sparky. Take a Quaalude there, accountant boy, and read the rules. Schedule C is for self-employment tax generating assets. Airbnbs generate self-employment tax when substantial services are provided. That's when they go on Schedule C, period. If you don't provide substantial services, it goes on Schedule E, even if it's a hotel for other purposes. Let me give you the classic. So I talked to you about when is it a hotel for self-employment purposes. Now let me switch a little. The definition of hotel, that's in quotes for those of you who can't see me, the definition of hotel for passive loss purposes is different. For determining if we have a hotel for passive loss purposes, there are two ways to be a hotel. Either the average rental period is 7 days or less, in which case for passive loss purposes, you're a hotel, or the average period is 30 days or less, and you provide significant services, which are like substantial, only not. Slightly different definitions. So, and what are substantial services? That's still gray in most cases. Like if you want to make sure you're providing substantial services, you want to make sure your Airbnbs are treated as a hotel for self-employment tax purposes. Just make sure there's maid service every day. That'll count as substantial services for sure. If you're not providing daily maid service, it's kind of gray how much you have to do for the people who are renting before the amount of services becomes substantial. The law is not yet clear on that. Coming back to the passive loss scenario, if you rent for less than 7 days, it's for passive loss purposes a hotel. But let's say you rent for less than 7 days, but do not provide substantial services. So it goes on Schedule E, it's a rental. It doesn't generate self-employment tax. For self-employment tax purposes, it's a rental and goes on Schedule E. But for passive loss purposes, it's not a rental, it's a hotel. Why does that matter? Because if it's a hotel, to make those passive losses active, it's a lot easier than being a real estate professional. Most of you know that to make rental income not passive, you have to qualify as a real estate professional, which is not easy to do. There are a number of rules. Your basic outline of those rules: 50% of your time in real estate, as defined by the IRS, not by you, what they count as real estate. 750 hours a year minimum in real estate, 500 hours a year hands-on landlording. Hands-on landlording. Some of you qualify as real estate professionals, some don't. If you don't have the time to qualify as a real estate professional, let's say you work a W-2 job, no way in hell you can argue that you spend 50% or more of your working time on rentals. No way. Could you have an Airbnb? You provide substantial services, or maybe you just rent it for less than 7 days. You have an Airbnb. You don't provide substantial services. No maid service, not much service at all. You rent it less than 7 days a year. Or I should say, not sorry, let me rephrase that. You rent it on average during the year for less than 7 days per tenant. The average rental period is 7 days or less. What does that mean? It's a rental for self-employment tax purposes. It goes on Schedule E. For passive loss purposes, it's a hotel. Why could that be good? Because the normal passive loss rules are easier to make. It's easier to make a hotel active, which if you have losses is a really good thing, because that active income, or I should say that active loss, offsets all your other income, right? If it's rental income, you got issues with using the rental loss to offset other stuff. If it's a hotel loss, it's way easier to make that loss count against all your other income. For example, I gave you the rules for real estate professional. They're hard to meet. Half your time in real estate, 750 hours minimum, 500 hours landlording, hands-on. To be active as a hotel is easier. If you work on the property over 100 hours and no one else, no other human puts in more than you do, then it's active. Let me give you an example. I have an Airbnb the first year. My average rental period on the Airbnb is 6 days. That's less than 7. So for passive loss purposes, it's a hotel, not a rental. How much time do I have to spend on it to make the loss? Let's assume I do a cost segregation and all that glorious stuff. It throws off a ton of depreciation. How many hours do I have to put in to make the loss active? I have to put in more than 100 hours and not less than anyone else. I have to put in more than 100 hours and not less than everyone else. So what do I have to track? Everybody's hours, including the guy who cuts the lawn, including everybody, the rehabber, the cleaner-upper person, every single human. I have to have their hours tracked, including mine. If I have more than 100 hours, let's say I have 120 hours, and nobody else has 120 hours, everyone else has less than that, I have an active loss. And it applies against all my income for the year. Now in year 2, can I change that? You know, in year 2, I didn't want to rent it out for these 6-day periods. That was annoying. I got all these Chads and Karens. So I'm going to turn around and rent it to nurses on 60-day periods. I'm now renting it for more than 30 days. For passive loss purposes, it's now a rental. But I'm okay with it. Why? Because the big losses were in year 1 when I did the cost segregation study. Could year 1 be the property didn't even start to rent until November? Could I put over 100 hours in between November and December of year 1? Sure. And then in year 2, I decide, oh, all this 6 and 7 day stuff. No. Makes me hate people even more. Makes me more Republican, less Democrat. Humans, bad. I mean, not so bad that we want to wipe them off the face of the earth with idiotic climate, environmental, lunatic legislation, not quite that level of hatred, but just general Republican misanthrope. And so after year one, I just convert it to a normal rental with a 90-day period for traveling nurses. Now, if it shows losses, I have to be a real estate professional. Oh, except I took so much depreciation in year one, I'm actually not showing losses anymore. I'm showing a gain because my depreciation is so low in year two onward. And so now what do I have? I have this beautiful thing known as a PIG, passive income generator. It's a rental property. It generates net income. If I have passive losses from other sources, I can actually use them to offset the PIG income. You have to rewind that and listen to it a few times. It's complex. That's why guys, the only reason I have a job that does not require actual productivity, like, curing cancer and stuff, is because the code is such a hot mess. And this is an example. It would make too much sense to define hotel and rental the same way across the board, but they don't. The definition of hotel versus rental changes depending on, are we talking about self-employment tax? Are we talking about passive losses, et cetera? So there's a basic. Now, what's my preferred entity structure if I have hotel properties? I like an LLC to hold. We do not put real estate into corporations. Repeat after me. We do not vote for Democrats. We do not put real estate into corporations. Repeat after me in order of importance, right? Marxists, bad. Rental properties and corporations, almost as bad. We don't do that. So we put these hotel properties into LLCs and we sublease to an S Corp or a C Corp or a ROBS or some combination of the three as we discussed. So what are we doing? We're generating regular rental income with the master lease. The net profit on the sublease. So the master lease is I'm leasing my properties to my S Corp at normal rental rates. What would it normally rent for to a normal tenant month to month? And then the S Corp turns around and rents it out by the day and makes way more money. That excess running through an S Corp, we're going to try and shelter it from self-employment tax because it's probably subject to self-employment tax. There might be enough services involved. You see where it gets complicated now? We have to ask a lot of questions. But my normal structure, if I have a hotel for self-employment tax purposes, let me repeat that. If I have a hotel for self-employment tax purposes, I'm providing substantial services, whatever that means. I'm going to master lease the property from an LLC to typically an S corporation, sometimes a C corporation, sometimes a rollover business startup, ROBS, depends on your circumstances. I'm going to charge normal rental rates on the master lease. The sublease is the premium for having Airbnb day to day. That premium, that profit above and beyond normal rental rates is going to be run through the S Corp, the C Corp, or the ROBS. And I don't do management agreements. It's a sublease, both for asset protection and tax purposes. Master lease to the related entity, it turns around and subleases, gets you a better result than having the S Corp or the C Corp or whatever act as the management company. That gets you a totally different result. So you got to be very careful with those nuances. Now, could I spend an hour explaining why? Yeah, because I'm skimming to give you as much actionable content as possible. We could go into painful, and I do mean oh so painful. It's why we drink. Detail.
Cheers. I can't even. Yeah, that's one that you must have stopped working with clients at the time because we have probably too many management agreements and not enough subleases. Thank you for that. We'll work on that later.
No, Nick, it's been a little while since we touched base. I love you. And for good and for bad, you are an entrepreneur. So it's also possible that you and your tax people do not touch base quite frequently enough.
It is possible. It is possible. I believe I reached out, and I'm only sharing this because I think the group can benefit from it too. I had a complete breakdown moment, I think in October of last year, where, similar to what you said about annual minutes and about keeping track of corporations and this and that, like I have an Excel entity schedule, and I realized how stupid it was. And I have whatever it was like 25 entities among 14 different states. And there's just there's no chance. And I'm like, I know I'm doing this wrong. You know, is Attorney John Hyre available? Can I please book a time? But honestly, it just became like, I burned it all to the ground anyway, John. So we'll talk later on about all that. So that's perfect.
Yeah, I mean, to get a hold of me, here's the key. You have to be persistent. You have to talk to Tina, help@realestatetaxlaw.com. I'm not looking for clients. I'm a pain in the ass. Sometimes I'm 1 to 2 months out. And if you don't set an appointment, you don't exist. Hint, Nick, if you don't set an appointment on a firm fixed date with your name on my calendar, you don't exist. And I mean, like, you text me, I ignore, you know this, Nick. I ignore texts. I assume it's all 1-900 foreign hooker stuff.
That's it.
And if I'm going to do foreign hookers with a jealous Chilean wife, I ain't doing like bald goatee dudes. Just saying.
The fact that you even gave me credit for a goatee, John, I'm going to take that. That's a win for me.
You know,
So
look, I wasn't going to say shadow. It seemed insulting.
Oh gosh, people don't want to hear that. All right, here we have a couple. You know what you mentioned, because you mentioned cost segregation, bonus depreciation, and hell, let's throw 1031 at the table, because I know that's below you, but hey, where is the future of 1031, cost seg in general, and then bonus depreciation headed in your world?
All right, let's start with 1031. I don't think it's going to change any. They've been proposing it since the 30s. Biden doesn't do math well. I mean, his math is probably even worse than AOC, which takes effort. And it's like, look, you have 50 in the Senate. You can't even piss off one of them. So what do they proceed to do? Thankfully, piss off at least 2 of them. So 1031, I don't think it's going to change. It's going to stay the same. Here's some advice on 1031. Don't call me. Here's why. The 1031 intermediaries, probably around 15, maybe 20 years ago, the good ones, decided that in order to get your business, they would give free planning advice. So to pay me I just had one of those calls today. We had a half an hour to lay out the issues for the lady, and I sent her to a 1031 intermediary, and I'll probably have to give her a refund on the 1 hour retainer. Depends if she needs me anymore or not. But I was honest with her. I'm like, listen, I listened. I listened to her issues. I said, here's your probable 1031 strategies. Here's the guy you want to confirm with, who will happily confirm or negate for free, as long as if he does confirm, he gets your business as a 1031 intermediary. So the intermediaries, not all of them, but a lot of them have gotten so sophisticated. I don't spend the time I used to spend researching 1031 because I can't bill much for it, because if I'm honest, and lamentably I am, I send people to where they'll get it for free. And then only in really weird esoteric situations do they come back to me. So 1031, I don't think is going anywhere. And the first place to go are the better 1031 intermediaries. And you can usually tell from their website. I mean, if they're talking about build to suit and reverse 1031 and drop and swap, those are the 3 things to look for. If on their website, they talk about build to suit, reverse exchange, and drop and swap, then they probably have enough sophistication that they can help you plan out your 1031, and you probably don't need to pay me or someone like me by the hour to do it. They'll happily do it just to get your business, and they'll do a really good job typically. Cost seg and bonus depreciation go kind of hand in hand. Cost seg, so you break up the property into personal property and into land improvements. Land improvements are anything outdoors on a rental, other than other structures like garages, anything outdoors that God did not put there. Landscaping, sidewalks, fences, blah, blah, blah. Normally that would depreciate over 15 years, which is still at twice the speed of a normal rental. And presently you get bonus depreciation, which is really good. It means you basically get to write it off in 1 year. You can also segregate personal property, which is my loose definition, anything a tenant can steal without the use of power tools. Most types of cabinets, carpet if it's been tacked down but not glued down, furniture, appliances, yada, yada, yada. You can bonus depreciate that. So the cost seg is in the first year, there's a bunch of stuff that you depreciate a lot faster than you normally would have, typically all in the same year. It's functionally a deduction. I think cost seg is going to be with us. I think the economics of it are going to change. Why? Because what's made cost seg extra sweet is the bonus depreciation, where you can take land improvements or personal property and depreciate them in year one. Now, bonus depreciation starts to phase out starting next year. Next year, you only get 80. So if you have bonus depreciation, if you have a land improvement, let's say, you have, I don't know, $5,000 worth of sidewalk on your single family rental. That's considered a land improvement. You can take a $5,000 write-off in year one. Well, next year, bonus depreciation goes to 80%. So if you have $5,000, you can only depreciate $4,000 in the first year, and the other $1,000 would be depreciable over 15 years. So the bonus depreciation is starting to fade out and go away, unless the Republicans win, which God knows this is a great opportunity, but never, ever underestimate the ability of Republicans to pull defeat from the jaws of victory and take a perfect situation and screw it up politically, because that is what they do. But assuming that, we shellac the Democrats in the midterms and we get a president in 2024, which who knows, if we get another Ross Perot third-party spoiler, that could really screw things up. So who knows? But if we get Republicans across all three, Senate, House of Reps, and the presidency, I could see bonus depreciation being renewed. In fact, I would pretty much count on it. On the other hand, if the Democrats hold any one of those three, then it's probably going to phase out on its own 20% per year. So you'll get 80% bonus depreciation next year, 60% in 2024, and so on. Now, cost seg can still be really valuable. I mean, personal property, I can still take code section 179 and get it all in 1 year. And land improvements still depreciate over 15 years versus land, which doesn't depreciate at all. So it's still a benefit, just not quite as big. So bottom line, I think cost seg is going to be with us either way, depending on who really super, super, super awesome, or it'll become merely really awesome, depending on who wins.
Got it. Noted. For those of us who have a bunch of properties now, like, is it worth, you can carry all of those losses forward, right? So is it a benefit to try to push everything in this year if it's a long-term?
Well, it depends if you have passive losses or not, right? If your losses in rentals are passive, it's a passive loss carry forward. In other words, passive losses hibernate, much like Biden, except that the passive losses may one day wake up. So the passive losses, when they hibernate, what wakens them? Either selling the activity, typically the property, but the activity, or having passive income. Either one of those two things wake the losses from hibernating. So if you're in a situation where you're creating passive losses that you cannot really use, cost seg doesn't necessarily make a lot of sense for you. On the other hand, if you're a real estate professional with rentals, or you're dealing with Airbnbs that for passive loss purposes are hotels, and so you don't need to be a real estate professional to loosen up those losses, yeah, then it might make some sense. Or even if the losses are passive, but you anticipate freeing some of them up in the near future, you're going to sell the activity, or you're going to have a PIG, a passive income generator. That's where we have to look at the details. But if you're having a passive loss problem and those just sit on your return, making your passive losses larger doesn't make a lot of sense.
Awesome. Okay. Someone just texted me, take a sip first before your lips get dry. Very good. So someone just texted me a question. Well, it's involving a seller finance transaction, owner finance. I know you have thoughts on owner financing. I would love to just hear your thoughts on that first, and then we can, if it's relevant, we can jump into his question.
Well, I mean, tax-wise, okay, so wait, Puerto Rico. Tax-wise, owner financing can make a lot of sense. There are some wonderful and sometimes subtle tax deferral games we can play, and especially with inflation, deferral is of great interest to me. Now, does it make economic sense? look, the last thing I want in an inflationary environment is long-term paper denominated in dollars. So if I'm going to do owner finance, it's going to be short-term, and there better be a benefit. What I don't want to do is like selling a house on a 30-year note. Do you want a note that's set at, let's say, 100 grand for 30 years? What's 100 grand worth in year 28, 29, 30? That's lunacy. So economically, selling on long-term owner finance makes very little sense. Now, buying on long-term owner finance, if you can find someone who's economically illiterate, you know, like they don't read Thomas Sowell, they vote for Democrats, so they deserve to have their money stolen from them. Would I buy from someone like that on owner finance in good conscience? Absolutely. Now, are there tax games we can play on either end of it? Absolutely. So now the more nuanced question, and let's get into opportunity zones. Somebody asked about that, and I do a lot with that. I'd like to talk about it because it is a huge tax break. If you fit, it's this little group of people who fit, but if you fit, oh, good Lord, is it glorious.
That's awesome. All right, we can jump in then. I think that was from Janine. Janine, do you actually want to unmute yourself and go over your question?
Oh, that's the question. That's it. I know nothing about it other than they should be glorious, and that's all I know.
Okay, let's talk about for whom they're glorious and for whom they're not and why. So there is some pending legislation that would actually be really good for opportunity zones and make them even more glorious. We'll see if it passes. It is bipartisan, so they may actually be able to agree on something. What's an opportunity zone? First of all, I get people who call me all the time. John, I bought a property in an opportunity zone. Where are my tax benefits? Oops, sorry, you screwed up. What do you mean? You have to buy in an opportunity zone fund. You have to create a special LLC or special corporation known as an opportunity zone fund. And without getting into it, there are some moving parts, but they're not cost prohibitive at all. You have to buy the property in the opportunity zone through the fund. What are the benefits of doing so? First of all, you can only invest capital gains in an opportunity zone fund. So if you don't have capital gains, you don't get to have an opportunity zone fund. If you have capital gains and you timely invest them, there are deadlines, of course, you timely invest them in the fund, those capital gains are deferred till 2026. It's just a deferral. They don't go away. It's a deferral. Now, this pending legislation would defer them to 2028 and actually forgive some of the gains. So we'll see if it passes. And that's the little benefit. That's the little benefit. Oh, we get to defer some capital gains. Yay. The big benefit, I refer to it as the JLO benefit. It's a great, big, beautiful back end. The best thing about opportunity zones, once the opportunity zone fund turns 10 years old, once the fund itself, the LLC that you set up, that's an opportunity zone fund, turns 10, it can sell non-inventory properties, meaning non-flips. It can sell any property that's not inventory, tax-free, no depreciation recapture, no tax, tax-free. They're encouraging you to buy properties in opportunity zones and to rehab or to do a new build or to find a distressed property that was abandoned or sold to you by a local government. Those are the four real basic requirements. Major rehab, lots of new build, the property was abandoned and you made it unabandoned, or you bought it from a local government. If you meet one of those four criteria, and there are more, I'm really grossly generalizing because I have to. If you're willing to do that kind of work, because rehabbing and building for sure is work. Buying a vacant property is work. Buying from a government, the property is usually suboptimal and it requires work. So if you can invest capital gains, you get a deferral on the cap gains that you invest in the fund. And more importantly, the gains you generate in the fund on year 10, day one, become tax-free, including no depreciation recapture. So what are the strings attached? You're dealing in some suboptimal areas and you're doing a lot of work. What's the upside? Capital gains deferral, some possible capital gains forgiveness, and those properties. Note, you don't have to hold the properties for 10 years. The fund has to turn 10. Let's say you buy a property in the fund in year 8, and you sit on that property for 2 years, and 2 years later, the fund turns 10. How much tax do you pay on the sale of that property? Zippo. Well, what about if I depreciated the living hell out of it with a cost seg study? How much depreciation recapture is there? Zippo. So you got to be willing to put it, you got to have capital gains. You can borrow. So if you only have 100 grand of cap gains and then you borrow 900 grand, can you invest $1 million in a opportunity zone property? Sure. You got to have cap gains. You got to be willing to do the work, rehab, build, deal with vacant properties, or deal with what were government owned properties, and wait for the fund to turn 10. If you're willing to do that, this is insane. And note that the pending legislation is, with one exception, friendly. It's bipartisan and friendly. The only bad thing about it is it increases the paperwork some. From what I've heard, the paperwork increase isn't bad. We do set these up, by the way, for people, private ones. So you can buy into an opportunity zone fund. There are a ton of syndicators that set up their funds as, well, opportunity zone funds. Great tax benefits. What's the problem? A lot of the times the economics just plain suck. The deal's raw. You can have your own self-owned opportunity zone fund. They're not that hard to run if there's a qualified person to teach you.
So that's, you're saying if they're taking a major gain on another property that they want to roll their cap gains into, most people though are syndicators, right? So if they start an OZ fund with you, at that point, they are raising capital. Can people invest capital? It's only the people who have significant capital gains that can invest the capital in an OZ fund, right? A qualified OZ fund.
All right, let's tailor that statement just a touch. Only people with capital gains who invest within a certain deadline can invest in an OZ fund and get the awesome tax benefits. Now, I'm investing in an OZ fund here in Puerto Rico. I don't have the capital gains, and I don't care because I don't pay that much tax here to begin with. So the fact that I'm not getting OZ fund tax benefits, I don't care. The deal itself is so good. I'm happy to get into the deal. So if you want the benefits I described, yeah, you got to have capital gains and you got to invest them timely.
That's brilliant. That's a big question. If you can you change the use of an opportunity zone property? Like, we have some people who are found in multifamily trying to do self-storage.
Yeah, no problem. As long as, here's the key. To do opportunity zone, one of the requirements, and I alluded to, there are other requirements and strings attached. You have to have a trader business, and that's a term of art. Let me give you an example. A triple net leased property is not considered a trader business under tax law. So we discourage triple net lease because it doesn't qualify. And then people want to get cute. Well, how about double net lease? Well, okay, you want to take the risk. It's aggressive, go for it. But no, if you do a regular lease, you pay the property tax, you pay the insurance, you're in charge of the maintenance. That's pretty clearly a trader business under tax law. And so you meet the requirement. So if you have a self-storage, you have to have enough activity such that it qualifies as a trader business. And I don't think that's hard to do. So can you convert the use? Sure.
Brilliant. We have another question that's another selfish question, but it comes from a couple other people besides myself. We have been doing some chasing yield, John, in this past 3 or 4 years of compressing cap rates in multifamily. And we have found we've been investing in mobile home parks for 6 years, but we found the almighty RV park strategy.
Oh yeah, that's the next new thing. Yeah.
It is the next new thing. Bryce, listen,
oh yeah, that's the hot thing right now. I mean, self-storage was it and still is, but it's getting harder to find. It's like the funeral home industry in the 80s. If you want to do self-storage, it's going to be in a tertiary market where you find someone who's 70, no offense to Tilney. You find out someone who's 70 and they don't even use spreadsheets for their so-called accounting. It's on paper. And they have retarded relatives on payroll. So the thing just does not freaking cash flow. Because with modern self-storage, that can be run through electrons and VAs. If you're managing it in any other way, it's grossly inefficient, especially if there are relatives involved. So you go by at their multiples, especially whatever they reported on their return, which is usually bullshit numbers. Like, oh, we forgot to report some of the income. Well, those are the numbers we're using for cap rate, bitches. So then you get it at a really good rate because it's poorly managed. And then you turn around and manage it properly using this thing known as the internet and Philippine VAs. And you start adding, for example, in the Southeast where the zoning's loose, or temporary non-real estate units where you can put the pods and the temporary units that are not so temporary. You can add capacity very quickly and so on. That's hard to do in primary and secondary markets now. It's gotten to be known. You can still pick those deals up in tertiary markets, especially if you're willing to consolidate 250 units in different sites, but within 20 minutes of each other. So I'm still seeing clients hit home runs on that. They're looking for people who don't know how to manage for squat, usually, sorry, Tilney, but in a certain stage of life with certain technology lacks. And that still works, self-storage. RV parks right now, with the housing shortage, we're seeing, along with tiny homes, it's really just a variant of tiny homes. We're seeing that right now really take off. That's a thing.
Amen to that. Yeah, and it's funny you mentioned that with self-storage and the lack of technology. That's exactly what we're finding in some RV parks, right? They've had long-term tenants now for 10 years, just year after year, seasonal rental with no software, no technology, and their father and brother are on the payroll for $250,000 a year, right?
Yep,
That's
bye-bye,
exactly.
cards. Off the payroll you go. Go collect some Democratic checks. Bye-bye. So here's a true story I just got from a client, and I'm sure you guys have lived this. We had one, it was an apartment unit. I don't know how many units. It was a good sized complex, like 100 units or something. And the guy bought it, I don't know, like 15 years ago and increased the rent 4% a year. And at closing, I mean, my client paid full asking price. And based on existing rents, hint, it was like, a 4 or 5% cap. And at closing, the seller, once the docs were signed, actually laughed in my client's face, like, you're a dumb SOB and you don't know what you're doing. And I doubled my money and I can't believe you signed this. And my guy was too polite to respond. He calls me later and he's like, the dumb SOB that sold to me increased rents by 4 to 6% a year. His rents are 50% below market. He's not been watching the news. And so my guy jacked up the rents to actual market, below cap rate. I mean, it's that kind of stuff we look for. And he was so polite. He was probably a better man than I am, because I probably would have been like, did our money hit his account? Yeah. Let me tell you what's going on here. God bless inefficient people.
Cheers to that. So, I mean, just as a general, more random investor question. So, as you all know, John's an investor. We're investors here. What is the asset class that tickles your fancy right now?
Yes.
Curious. Okay.
So
all of the above.
here's the awesome thing about Puerto Rico. The networking here is insane in any respect, whether you're looking for political sparring partners, intellectuals, philosophical people, entrepreneurs, business people, off the charts. Because think about it, we got Darwin here in a big way. The world needs more Darwin. The gene pool needs chlorine, lots of chlorine. So we have a Darwinian process here in Puerto Rico. You got to make enough money that it's worth it for you to move here. You got to have the, I don't know, the balls or uterus to move here. And you got to make it 18 months. Once you meet those three, you've passed through some filters. Let me tell you, the people I meet are interesting. I've been investing in a lot more varied stuff than I used to because of my client base. I used to do a lot of real estate, and I still do. But I have invested more in some tech startups. None of them have gone bust. One of them already 10x'd on me. And it's just talking to people and actually, I know hard to believe since I'm the one talking on the call, but actually listening and finding out what, for example, some of the hedge fund and venture capital guys are actually putting their own money into. And you, of course, with the unicorn shots, you got to diversify, right? 9 are going to go to squat, 1's going to go to the moon. You need the batting average. You can't just bet on a few. I got lucky on the one. So I've been doing that. The real estate deal I'm investing in is a local hotel deal. And it has more to do, as they say, with the jockey than the horse. Mm-hmm. I think any type of deal can make sense with the right person. And I've got this one client who is whatever he's a financial planner. Without going into details, he comes from a very success-oriented culture. And his due diligence is monstrous. It's just monstrous. I love it. And so pretty much if he invests in something with his own non-borrowed money, I am so in. And I've just seen his books and his returns, and I'm like, yeah, sign me up. So he's gotten into some hotel deals, and then there are local tax incentives. And here's how he sweetened the deal. He went and got, which is easier to do in Puerto Rico, subsidized debt. He got some USDA debt, which applies across a lot of the island. Puerto Rico is short of hotel rooms, a lot of tourism. The properties were bought for very little. This guy knows how to play the local political game, and he got subsidized debt. And then he went and put in 6 figures of his own money. Game on, I'm in. I'm piling in as much as I can on that one. So I look at different stuff. I factor. I buy medical debt through an intermediary who's very good at selecting medical debt. We do factoring in Georgia. Georgia has a unique set of laws when it comes to, or not unique, but close to unique in terms of no-fault insurance. And so we buy medical debt there from younger doctors. The older doctors just sit on their debt and season it. They don't want to sell at a big discount to get the money now. We buy car accidents, small car accidents. I don't want a big car accident. If there's a bone sticking out, the insurance company is going to fight it. That's annoying. I want small car accidents where we've got whiplash and an MRI and not much more. And you can buy that stuff if you got the right people around at 50 cents on the dollar. And in a state where there's always insurance, I mean, what's the first thing you screen for? Who's their insurer? Well, I only want the large blue chip insurers. I know they're going to pay. It's only a question of how much and when. And there's a matrix for that. There's an experience table of when we're dealing with this company and this kind of accident and this doctor and this lawyer, here's what's going to happen. So those are some of the things I'm investing in. And it's the people. The networking here is insane.
Yeah. Amen to the people. I love that.
I'm the
folks,
rational one. I'm the rational, quiet little one. I'm dead serious, man.
Oh God, I love this.
It's something here, the ecosystem.
It has been way too long since we've had you in these groups, John. I appreciate you, the Zoom. If anyone has any last minute questions, feel free to post them in the chat, or you can raise your hand. We'll get you guys in. Once again, I really, really appreciate everybody's flexibility tonight. We're an hour and a half in, which was actually 2.5 hours if you were waiting for the hour. But
and raise your whole hand, all 5 fingers, not just one. We don't appreciate that.
Indeed. I'm looking and scanning right now. Does anyone have any questions they want to post in the chat or talk to John about? We covered seller financing. We covered entity structuring to a point. For those of you who are taking notes very, very quickly, you now know how to properly set up all your entities. You know how to write off almost all your home office deductions. You know how to set up a Roth, oh God, I didn't know the name of it. Retired.
Rob's Rollover Business Startup.
That's the one. Rollover Business
And
Startup.
we have an outfit we recommend. Hey, Nick, can I whore myself out for a minute?
You can whore by all means.
I think whoring is totally fair. It's not my services. I have taken a little bit of an intermission from info product. We're getting ready to put more out. I do a webinar that's twice monthly, and it includes a lot of Q&A. It's a lot like this call. Every bit is respectful, reverent, but also a lot of Q&A back and forth. Next month topic will be tax implications of subject to, both as buyer and seller, because that's becoming a hot thing again for good reason. And so that we do one topic a month, usually something like that, and then one just raw open Q&A session with priority to questions that were sent in ahead of time. I took off a lot of this year from doing seminars. I just wasn't in the mood, the in-person stuff. I'll be picking it up again in December and doing a lot more. Usually I focus on 2-day seminars on self-directed IRAs and 401ks, including a lot of things we alluded to. 2-day seminars on entities and asset protection. And we probably will bring back, I used to sell a bookkeeping course that was obsolete about 5 years ago, how to do bookkeeping for real estate so that I don't have to look at your damn shoebox. We'll probably bring some version of that back. So if you go to, what the hell is the name of my website anyway? Tax Reduction Class and taxreductionlawyer.com. You're going to see more content coming out. But I'll tell you that monthly webinar, we do 2 a month. It's only $100 a month. And you got 3 years of archives covering very detailed subjects. Like last month's subject was a 4-hour well, it was about 3 hours, 3.5 hours really. So I lied slightly. 3.5 hours of Airbnb discussion in detail. And then there was another follow-up seminar, just Q&A about the Airbnb. And it works for me at $100 a person, because if we get enough people, I got 300 some people on those, that, you know, you do the math with the volume, it's worth doing. So if you're interested, great. And if not, well, I don't know, go vote for a Democrat and pay more, whatever.
For those of you, obviously, John gave his time freely tonight to us. And yes, I can obviously personally vouch that every single, he might be one of the most brilliant people I know, but I don't want to make his head any bigger. So what we'll say is that he has amazing content, and the Q&A alone is worth the investment. And as we talked about earlier, what does Nick get if you go and sign up for his course? We get zero. We get zero. REI Unleashed, Ignition, and Accelerated do not get anything by signing up for his course. He's been a very, very, very close friend and advisor of mine for years and years and years. We do have a couple of questions that just came to me, though, John. We have one from Ed Taylor, our good Florida RIA friend.
Ed, down in Sarasota.
He's here too. He said he would love to just know general opinions on the current rate bump and the recession that is here. What do you think about it?
So we're going to have a recession. Here's my personal cynical view. The Democrats know they're going to lose in the midterm, so they figured, screw it, we might as well raise rates now. What if we got to lose? I think they want to turn shit around before 2024. I'm being very cynical. I don't think the Fed is at all independent. I think it's a joke. I don't think they're going to stick to the rate increase. I think it'll go 1.5 years tops. Maybe, if they're extreme, 2 years. They can't stick with it. The US government's the largest debtor in the history of ever. And if you look at what percent interest now takes of the federal, I mean, it probably was 20% until they raised rates, and now it's probably 40% of the federal budget. So it's a good show. And they want to say, I mean, because right now they do know that inflation is at the top of the polls, but I don't think they have what it takes to hold the course all the way. I give them 18 months. Could be wrong, happens a lot, but that's my gut feel. 18 months. I don't think they can stick with it.
Interesting. All right, let me throw this at you then, just because this is a great topic of conversation. The people who received their mortgage statements, right, in November of last year, and then had to wait another 6 months because, well, the left is kicking the can down the road on when they can and can't submit their mortgage payments for not having to pay their mortgage for 18 months prior. Those people, mostly under, my understanding is mostly under the values of $600,000 across the country. Does that change your opinion on the potential single family correction that a lot of us feel is coming?
No, because a couple reasons. There's no way they're going to let there's no way that those people are going to go into foreclosure. That's not politically going to happen. So whatever fix they have to make to the law, even if retroactive, to say, listen, you didn't pay for a while, we're good, just tack it on at the end, whatever we have to do, they're going to do, period. Second,
We've already started, yeah.
This isn't 2008. For the most part, they're not making stupid loans. For the most part, what do we have? We have a lot of things contributing to inflation. Tariffs, far and away the largest components, regulatory, but also human nature. Humans are much more efficient, closely packed in. Unfortunately, we also do very stupid things when we're closely packed in. It's then as a mob. But cities are efficient. 10,000 doctors in one city will get way more done than 10,000 doctors spread throughout the country. Concentration, specialization, economic efficiency. Plus cities are fun. There's more to do, most of it inappropriate, but that's people. And so people continue to buy in the cities. The cities continue to get more expensive because of regulation, lack of space to begin with, inflation in materials, supply chain issues have accelerated that. Now, what's the limit ultimately going to be? Income. But if inflation is increasing, at least in nominal terms, income, I think it'll still continue to be affordable-ish. Now, one of the keys will be, do they continue to allow, for example, one house to be rented bedroom by bedroom? That's taking some of the pressure off for the younger people, that they can rent one bedroom. And there are companies that do that, and there's software. I've got clients, that's their specialty, is renting by the room and coming up with a workable set of rules. I got clients that buy subject to in nice areas, and rent by the room, and they can make it cash flow. And as long as the idiots don't make stuff like that illegal, the way they try and do with Airbnb, it's going to be a pressure valve on some of that demand. But because what's pushing the prices is true, honest to God cost, as long as incomes, at least in nominal terms, keep up with it. Now you're going to see the continuing two Americas. The part of America that doesn't have increasing income is going to have a much harder time of it. All the builders are doing upper income stuff. Why? Well, that's where the money's at, and there's far less regulation. So they regulate low income and make it harder, and it's already harder because things are so expensive. And so the same people who say they love the poor screw the poor silly, which is what inflation does. I can afford to pay $10 for a cup of coffee. I'm not pleased about it, but I can do it. Not so much half the country. And so I think you're going to see the same dynamic with real estate. Now, I do think that you're going to see a slowing because of the increase in rates. I don't think you're going to see a lot of drops. Here's what's interesting. I just saw a stat the other day. New housing has dropped in terms of sales. There's been an active drop recently. Existing housing, the growth has slowed, but there's not been an active drop. That's a very interesting statistic to me.
That was delicious.
That was delicious. I agree. John, that was wow. Okay. Ed, do you want to chat with him on anything like that, or are you in good shape? You can
Ed's
unmute
always in
yourself,
good
my friend.
shape.
I guess he is in good shape. Oh, he's not. Okay, he's not in a position where he can speak, I don't think. That's okay.
Oh
If you
God,
wanna
that's
jump in,
Geez, Ed, what does that mean?
Actually,
Is
my
there
wife,
duct tape involved? Oh my God.
that was delicious. I apologize.
You go, Blair.
No worries at all. No worries at all. I think Ed said that he'll do a sidebar. Okay, brilliant. Wow, this has been, as usual, way over value. Wait, is it the over promised under delivered? Now I've had 4, so I'm starting to slur a little bit, but that's okay. How many? What are you at to? What are you at?
Oh, I already had, look, dude, this bottle I brought was full. Now I had help. It wasn't just me. And I'll be fine. I don't drive stupidly, but I make a joke, and it's just a joke for the NSA, since the NSA can't take a fucking joke and listens to everything we're doing. So I joke, I tell people deadpan. Now it's not true, but I say, why are there no drunk driving laws in Puerto Rico? I mean, there are, but I pretend there aren't any. And so I say, why are there no drunk driving laws in Puerto Rico? And my answer is, you can't tell the difference.
I get that. Excellent. Oh God, I can't wait to visit with you folks, especially in Puerto
Dude,
Rico.
get on down here.
We have actually, you know what? Someone did share the link in the chat. Now I switched my view, and of course, being me, I don't know how to get back to how to do that view. Dan Milanazzo, you shared the link. What was the link again? I'm gonna
Taxreductionclass.com. And
tax
we'll put some
reduction
classes up there. Aside from my monthly stuff, I just haven't been doing anything lately. I wasn't in the mood, but we do have one coming up in November and one in December that we'll post on. And then we have the advanced strategies class in Atlanta in January. So I'll post all that eventually. I just kind of took a year off. I mean, not completely off, catching up with client stuff, creating some content, but you know how it is, like you've been there. 1 minute I want to travel everywhere and this is so much fun. And then all of a sudden you're like, oh my God, I would rather just die than travel.
And
so
then you
have the
become-
pendulum swing.
And then you go
So
into
I
a
just kind of
divorce
took a year
custody
off
schedule, and
from-
you can't do anything.
I'm sorry?
And then you go into a divorce custody schedule, and you can't do anything anymore. No, just kidding.
Dude, I
Just
married
kidding.
a Latina. There is no divorce. There is the ground. You become plant food. So
I love it. We get close here on REI Unleashed National Networking. We know each other's stories.
yes,
love
yes. TMI everywhere.
You did not disappoint. I know everyone here is feeling the same as I am. The knowledge here was absolutely incredible. And as I promised to all of you, he is certainly not a boring tax attorney accountant, as you all knew. So I want to thank all of you guys for joining with us and rolling with the punches tonight. We all had some punches to roll with. I'm not even going to mention what happened earlier, where we almost lost John for a night. So we won't even mention that.
No, it was one of those days, man.
It was one of those days for all of us.
Oh yeah.
It was for all of us. But you all have hair and I don't. So here's the deal. Next REI Unleashed National Networking Meeting. If you're local to the Northeast, we'd love you to join us. This one's going to be live in person at Salvatore's Restaurant in Lawrence, Massachusetts, June 21st. We'll be talking about, mark your calendars, please. We'll be talking about property management practices, good, bad, and the ugly. And here we have a national speaker here today that can also jump in on that, maybe. Good, bad, and the ugly. We'll see you there if you're local. If you're not, join the Facebook group, REI Unleashed National Networking. Please join that group on Facebook right now. Answer the questions, and you'll be staying tuned for our next Zoom or fix and flip events, which will be posted in that group. We have amazing, amazing people, but today we were super, super psyched. John, that was way over delivered, man. Really appreciate it, as always.
Take care, man. I'm gonna go drink and stab people. Or
Go
stab
drink
people
and
in
stab
the face.
people. Folks, enjoy your night. We'll see you next month.
Thank you.
Bye.
Thanks, everybody.
Thank you.
Thank you.